Hello there, Hector DeVille here. In this particular video we are going to be studying the reversal formations, alright, the type of price patterns, candlestick formations that are going to hint an upcoming reversal move. Alright, obviously if we are going to trade a reversal, we are obviously going to locate that reversal, as you know, around a level of support and resistance, and we are going to be interested only in those reversal formations that happen around well, a level of support and resistance. As a case example, okay, just to make for the sake of discussion, well, I've located here a horizontal line which represents, again as an example, a resistance line on the daily time frame. Now obviously this could be the daily, the weekly, the monthly, it doesn't matter, right? All these principles are universal across all time frames. All right. Also, it doesn't have to be a resistance, right? It could also be as they could also work as support. We would just need to place these formations instead of under the resistance line. Well, we would place them, or we would search for them above the support line. All right, and also, well, this resistance line doesn't have to be a horizontal level of support and resistance. We can also find these formations of a diagonal level of support and resistance, meaning trend lines. Also maybe a confluence of a trend line along with a Fibonacci retracement, okay, that being the previous swing down. Then we go price gives us a little bit of a pullback back to the 38, 50 and 61 Fibonacci retracements. Well, around that area, if we find any of these different reversal formations, well, that would give us, that would clue us in that the next upcoming move is going to be a reversal move into a whole new swing in the direction of the trend. At any rate, whenever we find a resistance level, all right, any support or resistance level, these are the formations that may indicate an upcoming reversal move. So since this is a resistance, that means that price is immediately below that level, all right, maybe coming back to retest that level. If as price climbs up to retest that resistance level, well, any of these formations that we may get just below, okay, just below, because it's resistance, it would, if it was support, we would search for these formations, as I mentioned before, just above that level. So if we find any of these formations just below resistance, any resistance level, we are looking to trade a bounce. In a future video, I will explain, or I will show you guys the breakout formations. On this particular video, we are gonna just stick to reversal formations. Okay, all right, well, out of the as you can see, 5 different reversal formations we are going to be studying on this presentation, 3 of them are high quality ones and the last 2 of them are low quality ones. This doesn't mean that they are not, they are not tradable. They are indeed tradable, but you will probably see in the long run a little bit of a lower win-loss ratio out of these ones than if you just stick to these ones. Okay, again, you can trade them all, right? If you trade them correctly, they are all profitable, but again, the quality signals and therefore the win-loss ratio in the long run is going to be a little bit higher of these ones, right, than just of these ones. Okay, I'm gonna go through all of them, and then, well, you decide whether you want to go for the conservative route and therefore you just trade the first 3, or the aggressive route and you simply trade them all. By the way, before I get started, just to avoid confusion, these are all individual candle formations. All right, you're not supposed to be searching for all of these, okay, at once. Just one of them. All right, this is one formation. You can either get reversal formations taking the shape of a hammer or a pin bar, which is basically the same thing, or a railway tracks, or an outside bar, etc., etc. You are not supposed to search for all of them at once. All right, I just wanted to clear that up. All right, let's get started with the first one, which is also the most prototypical one, the most common one, and the most easily recognizable one. All right, that's the hammer or the pin bar formation. A hammer is basically a one candlestick formation, okay, a combination of just one single individual bar where the body of the candle is small, and well, you have a short wick to the downside and a long wick to the upside, touching that level of resistance. If it was a level of support and price was coming down to retest that level, well, the hammer should look the other way around, all right? Small body, small wick to the upside, and a long wick to the downside, okay? This is obviously a bearish hammer, since this is a reversal formation that's going to point to the downside. A bullish hammer, as I mentioned before, looks something like this, all right? And well, it hints the reversal in the opposite direction, meaning to the upside. It's also called a pin bar, and that comes from Pinocchio Bar, all right? The famous Disney character. And the reason of why it's called Pinocchio Bar is because of the long nose, because it's a lying nose. All right. Basically, it indicates that price is going to move in one direction, but rather soon, rather fast. Well, it fakes you out, because the actual direction that price is likely to take in the upcoming move is going to be in the opposite direction. Okay, that's why it's called a Pinocchio bar. All right, well, the hammer or pin bars don't always happen right off that particular level of support and resistance. That means that they do not always touch to the pip and then they bounce sharply off that level. Sometimes the long nose, the long wick, does indeed breach through that particular level. All right, but we are not going to be covering those specific cases, scenarios, case examples on this video, because that doesn't fall in the realm of reversals. That falls in the realm of fake breakouts, right? You see how that's a fake breakout? Okay, price seems like it's about to breach through, but immediately after it comes back down, and well, basically all the people who weren't who were looking to trade the breakout there got actually faked out, and probably their stop losses got hit as price plummets in the other direction. That's why it's not a reversal, it's a fake breakout, and we are gonna leave that for a future video. All right, we could also apply the same thing to all these different formations. Actually, the railway tracks can be either a reversal formation, it looks just like that, with price touching and bouncing right off that particular level of support and resistance, or it can take the shape of a railway tracks, as in a fake breakout, and then it will look something like this. Price seems like it's about to break through, and immediately after it pulls a 180-degree turn, and it turns all the way around in the opposite direction. That's again a fake breakout. All right, a fake breakout formation, and again, we are going to be covering all that in a future video. All right, let's go back to the hammer or pin bar. As you can see, I've colored the body of that candlestick, all right, the actual body of the candle in gray. That's because it doesn't matter whether it's a green or a red candle, all right? Since the body is so small, all right, the actual color of the body is just totally meaningless, all right? What's important, the key point, the key element in a pin bar is the long wick, all right? The longer the wick, the better, and the sharper it touches that level of resistance, support and resistance, also the better. The nature of the pin bar is basically heavy market rejection. All right, a pin bar signifies rejection of a key level of support and resistance. So if you see price coming back to retest a level, in this case of resistance, again on this case example, and you see at the top of this up move, all right, price opening, giving us a small body, and then, like I say, a long wick, a long nose into the upside, and then coming back down just as sharply to close at the same, more or less at the same level. If this was a green bar, well, that would be the open and that would be the close. If it was a red bar, that would be the open and that would be the close. But at any rate, since the bar is so small, as I was saying before, both the open and the close are going to be more or less at the same level. You can even get a cross, all right? A cross where the body is totally non-existent. Basically, the open and the close is literally lining out at the same level. But at any rate, like I said, what's important here is that price within this trading session, within this one day, since this is the daily chart, or within that week, if that was the weekly time frame, well, within this particular trading session, price has opened and closed at the same level, but from an intraday perspective, right? Again, intraday perspective, price came back up to touch that level, and it found such a heavy rejection that the market drove all the way around where it all started. Okay, the key element of that's why I say that the key element of a hammer formation is that long nose, which is got to be at least twice as long as the rest of the body and the small candle combined. Okay, a hammer needs to, I mean, it's the number one characteristic. Okay, long nose into one side and small body and a small lower wick into the other side. All right. So if you find this type of formation, all right, one individual candle with a long nose touching right to the pip, well, you can identify heavy rejection, heavy selling pressure around this area. That means that the bulls were strong enough to drive price all the way to these particular levels, but the sellers, the bears, right, the people building selling pressure or willing to click on their sell buttons, they were waiting at that particular level in volume enough, well, basically with enough orders to drive price back down in sharp momentum. All right, that usually indicates that that level of resistance is going to hold, and the next immediate move right after this particular hammer is going to be indeed to the downside. It's all about selling pressure or selling volume waiting at that particular level. So as soon as price touches that level, bang, it comes back down, and like I say, the most likely move in the upcoming day is going to be another red candle, all right, another red candle to the downside, all right, and this is where we are going to make our money. So how do you trade a pin bar or a hammer candlestick right off a level of support and resistance? In this case, resistance of the daily time frame. Well, first of all, you need the candle to close. All right, you cannot label any bar as a pin bar or as a railway tracks or as an outside bar, etc., unless the bar is finally closed. So since this is the daily time frame, you simply need to come back at the end of the day to your charts. Just sit for a second, all right? At the end of the day, at whatever time your trading platform closes the daily bars, and again, wait for the bar to close. Obviously, if you were trading off the weekly time frame, you will need, you know, the week to come to an end, and you could sit at your trading station, for example, over the weekend or on Friday evening, you know, whenever the markets are closing for the week. All right, but at any rate, you need the individual candle to close. Then there are two ways of entering the trade. One is a conservative one, the other one is the aggressive way. Well, let's assume this is actually let me just color it. Okay, let's assume this is indeed a red candle, all right, and therefore that's the open of the day and that's the close for the day. Well, the aggressive way of entering the trade would be to click on your sell button as that bar closes. How is that? Well, because you are already recognizing the hammer formation, all right, banging onto that level of resistance and therefore signifying heavy rejection, and you know that statistically wise, chances are that the next move is going to be to the downside. So you don't really wait for the confirmation of this pin bar. As soon as the bar closes right there, and as soon as obviously the next bar opens, which obviously happens immediately after, well, that's where you click on your sell button. The conservative way is to wait for price to breach the low of that bar, all right, of that hammer formation, all right. So as soon as price begins to go down and to tick 5 pips, you know, my personal preference is just 5 pips below that low, all right, for that hammer, well, that's where I place my sell stop order. Okay, you simply tell your broker I want to sell at this price, and once price opens, the next bar opens and begins to trail down, well, that's where your broker executes your sell order, and therefore you are effectively shorting the market, searching to exploit, you know, further moves to the downside. Again, conservative way, wait for the for price to break the low on the next candle, right? On the next candle, wait for price to tick below 5 pips below the low of the hammer. The aggressive way, as the new bar opens up, right there is where you click on your sell button. Depends on how aggressive you are. I personally prefer the conservative way. I personally wait for price to confirm this bounce by breaking below that low of the hammer bar. All right. What about the stop loss? Again, two ways of dealing with the stop loss placement: the aggressive and the conservative way. The conservative way, simply place it 5 pips above the high of that the high of this pin bar, right there, 5 pips there. The aggressive way, well, you simply measure the entire distance from the low to the high of that pin bar, mark 50% of that distance and place it 10 pips above that 50% level. All right. Again, the idea here is that once price begins to trail down, it's very unlikely that price will come back above that 50%. Okay, once the trade is triggered, it's very unlikely that price will actually come back up there. And if it does come back up there, chances are that this hammer formation is not going to work out at all, and price will simply keep on pushing to the upside. All right, so it depends again on how aggressive you are with your trading. I myself, I like to be conservative with my entries, but I like to be aggressive with my stop losses. So I like to enter 5 pips below the breakout of that hammer formation, but I like to place my stop loss 5 pips above that 50% of the entire range for that pin bar. Right? Very simple. Just measure the entire distance, mark the 50% level, and place the stop loss 50. Once you enter the trade, place your stop loss again 5 pips above that 50% level. Okay. What about the target level? Well, the target level is going to be dictated by the upcoming bars. All right. So what you do is you simply, again, assuming price triggers your entry as it should on the very next candle. Actually, let me just copy paste. Just give me a second. I'm gonna try to nail it down. Copy paste. All right, there we are. Let me bring that forward. Again, it doesn't matter, so I'm just gonna, doesn't matter the colors, I'm gonna just color it in gray again. So up on that pin bar, we get our entry bar, right? That's our entry right there. Our stop loss should be right there. Our first target, I always like to exit my trade in all my trades in a sequential manner, right? So what I do is at the close of this next bar, again at the close, you need the candle to close. So you come back at the end of the day, and whenever it closes, you simply close 50% of the trade. All right, just 50% of the trade, and then you trail your stop loss from your entry, either there if you were aggressive with your stop loss, or there if you were conservative. You simply trail it to if you are aggressive with your stop loss from Here you move it to break even. Okay, break even. If you are conservative with your stop loss, you move it from there to 5 pips above the high of your entry bar, okay, meaning that bar there. Again, it all depends on how you want to deal with your stop loss placements, aggressive or conservatively. Aggressively or conservatively, depends entirely up to you. I like to be aggressive with my stop loss, so I usually move it from there all the way to break even. So I simply trail it to break even to offset the risk on that trade altogether. And then what do I do with the remaining 50% of the trade? Well, in my experience, whenever you see a sharp bounce off a significant level of support and resistance, you usually see momentum enough in the opposite direction for 2 consecutive bars. Again, that's just my experience. So what I like to do is I wait for the second candle to close. All right, I close 50% of the trade there and another 50% of the trade there. Usually the second candle is not as profitable as the first one because the momentum, the down momentum is dying out by the time by the time this second bar pops up. So you usually see something like this. All right, something like that. Nice move down immediately after the hammer is triggered. All right, and then also usually you get momentum for another down bar, but it's usually not as large as the first one. Anyway, to wrap it up, entry, stop loss. At the close of this first bar, you move your stop loss to break even, and then you exit the second portion of the trade at the close of the second bar. Regardless of this second bar is down or up, regardless of the color of this second bar, you simply close it at the close of the second bar. In the other hand, if you were conservative with your stop losses, that's your entry there, your stop loss is there. At the close, you exit 50%, you trail your stop loss up here, just 5 pips above that bar, all right? And then at this point, you close the remaining 50% of the trade, all right? That's basically how it works. That's basically how you trade the hammer or pin bar formation. Now,